Let's talk about one of the biggest, most common pieces of investment advice out there, something you hear everywhere. And it turns out the legendary Charlie Munger, he basically called it a complete lie. And his reasoning? Well, it's a total masterclass in why sometimes the absolute smartest thing you can do is nothing at all.
So here it is, straight from the man himself. He says the great lie is this idea that an immediate stop loss is an iron rule. I mean, you hear this everywhere, right? It sounds so smart, so responsible. But Munger, he flips it on his head. He asks, what if that so-called safety net is actually the thing that's holding you back?
And this really breaks it down perfectly. On one side, you've got the Wall Street mantra, always be busy, set a stop loss, get in, get out quick. It feels like you're doing something, right? Like you're in control. But then you look at the other side, the truth of how wealth is actually built. And it's the total opposite. It's not about being busy. It's about letting time and compounding do the heavy lifting for you. And, this is the key, controlling your risk before you ever click the buy button.
Okay, so why is being busy so bad for your money? Well, it all comes down to this concept of trading friction. Just think of it like this constant, invisible drag on your portfolio. It's eating away at your returns in ways you can see, and more importantly, in ways you can't.
All right, first up are the costs you can actually see on your statement. The obvious stuff. Every single time you make a trade, you're getting dinged. A little commission here, a tax bill over there, a tiny piece lost on the spread between the buy and sell price. And yeah, one by one, they don't seem like much. But add them up over hundreds, maybe thousands of trades, it's death by 1,000 cuts for your portfolio. Seriously.
But honestly, those visible costs, they're small potatoes compared to the invisible killers. This is where the real damage happens. I'm talking about decision fatigue, just the mental exhaustion of having to make call after call. Then there's the emotional roller coaster, right? The fear and greed that makes you buy high and sell low. You become your own worst enemy. And maybe the biggest one of all, opportunity cost. Just think about it. How many incredible, life-changing companies have been sold off just to lock in some tiny, meaningless gain?
This analogy is just perfect. We've all seen this driver on the highway, haven't we? The one who's constantly weaving between lanes, slamming on the gas, hitting the brakes. They look super busy, they feel like they're making incredible time, but you and I, from a few cars back, we can see the truth. They're just burning a ton of fuel, jacking up their risk of a crash, and in the end, the steady driver who just stays in their lane gets to the destination at pretty much the same time, but way less stressed.
So, if being busy is the problem, what's the solution? Well, it's about embracing what Einstein supposedly called the eighth wonder of the world, compounding. And it all boils down to one deceptively simple principle.
And this is it. This is the whole secret sauce. Don't interrupt unnecessarily. It sounds so simple, right? But it is everything. Because compounding, it needs one thing more than anything else to work its magic. A long, uninterrupted runway of time. Every single time you sell, you're grabbing that snowball at the top of the hill and breaking it apart, forcing it to start all over again.
Here's another way to think about it that I love. Imagine you plant a beautiful oak tree in your backyard. Would you go out there every few days with a shovel and dig it up just to check on how the roots are doing? Of course not. That sounds completely insane, right? You'd kill the tree. Yet, this is exactly what millions of investors do every single day. They call it managing their portfolio or taking profits, but what they're really doing is yanking their best ideas out of the ground before they ever have a chance to truly grow.
And this gets to the fundamental math of it all. Compounding is multiplication. It's exponential. But when you're constantly jumping in and out of stocks, you're not multiplying anymore. You're just doing simple addition. You are literally swapping an explosive, upward curving line for a boring, flat one. You're taking apart the very engine that's designed to build your wealth.
Now, all of this sounds really simple on paper, doesn't it? Just buy good stuff and wait. But it is incredibly, incredibly difficult in practice. And why is that? Because the real fight isn't with the stock market. It's a game against ourselves, against our own human nature that screams at us to do something.
And this requires a complete shift in how you think about risk. We're all conditioned to fear volatility, the day-to-day ups and downs of the market. But Munger would say that's not the real risk. The real risk, the one that can permanently wipe you out, is buying a junk company in the first place. So the only question that really matters is, how do you tell a great company from junk?
Munger's answer to that is just brutally, beautifully simple. It's your circle of competence. You have to have a deep, real, genuine understanding of the business you're putting your money into. I'm not talking about a vague idea you got from a news headline. I mean a real understanding. And he's famous for saying that 99% of people who think they get it are just deluding themselves. If a business falls outside that circle you've defined for yourself, the only right move is to do nothing. Just don't touch it.
See, when you operate strictly inside that circle, your whole relationship with the market changes. You can start to treat it like a moody, emotional business partner, what Ben Graham called Mr. Market. So when Mr. Market has a total panic attack and offers you fantastic companies at ridiculously low prices, you just calmly say, "Thank you very much, I'll take some." And when he gets totally euphoric and greedy, offering you those same companies at insane prices, you just politely say, "No thank you, I'll wait." You use his emotional swings to your advantage. You never, ever let them become your own.
So really, your entire investment process, all that complexity, can be boiled down to this simple 3-point checklist. Number 1, is this a fantastic business that I actually truly understand? Step 2, is the price I'm being asked to pay fair or even better, cheap? And number 3, is the management team honest and capable? If you can say a big yes to all 3 of those, guess what? Your work is pretty much done. Now comes the hardest part of all, which is just sitting on your hands.
And that idea, the waiting, the doing nothing, that brings us to the most radical and counterintuitive part of this whole philosophy. The simple fact that true mastery in this game isn't about frantic action. It's about the deep wisdom of inaction.
Okay, let's make this real with a quick story. The tale of 2 investors. They both start with the exact same amount of money, let's say 100 grand. The first one is the active trader. He is busy. He's watching the market all day, chasing trends, setting his stop losses, reading every single report. After 5 years of all that stress and effort, he's pretty much right back where he started. Maybe a little up, maybe a little down. Now, investor number 2, the patient holder. She does her homework up front, buys a few really great companies she understands, and then she goes back to living her life, her job, her family, her hobbies. 5 years later, she checks her account, and it's tripled. What was the difference? It wasn't about being smarter. It was about temperament.
And this is just such a powerful, mind-bending paradox, isn't it? Our whole culture screams at us that being busy means you're being productive. But in the world of investing, the person who looks the busiest is often just frantically digging their own financial grave. The real masters of the game, they often look like they're asleep at the wheel. That's because they did all the difficult, intellectual work years ago, and now they're just letting their good decisions do the work for them.
So I'll leave you with this question to really think about. Is investing a game of speed, or is it a test of your ability to endure boredom? Everything in our world, our phones, the news, social media, it all screams for speed and action. But what if the greatest fortunes aren't built by sprinting from one hot idea to the next, but by having the incredible patience to just sit still and let time do its thing? Answering that question for yourself, well, that might just change everything.